Have you ever wondered what a reverse mortgage is? Well, let's break it down together. A reverse mortgage, simply put, is a type of loan designed specifically for senior citizens. It provides an opportunity to convert a portion of their home equity, that's the value of their house, minus any outstanding mortgage or other liens, into cash. Imagine having a piggy bank, but instead of it being a small ceramic object on your dresser, it's your house. And instead of depositing pennies and dimes, you're depositing years of mortgage payments. Now with a reverse mortgage, you get to crack open that piggy bank and use the money inside. It's an interesting concept, isn't it? And it's a tool that many seniors find useful. But like any financial decision, it's not without its complexities. Now that we know what a reverse mortgage is, let's dive deeper into how it works. So, how does a reverse mortgage work? Well, let's start by imagining your home as a piggy bank. The more you've paid off on your home, the more money you have in your piggy bank, or in other words, your home equity. A reverse mortgage is a loan that allows you to tap into this equity without having to sell your home. Now you might be asking, how is this different from a regular mortgage or a home equity loan? Excellent question. Unlike a traditional mortgage or a home equity loan where you make monthly payments to a lender, a reverse mortgage pays you. Yes, you heard that right. The lender pays you in a lump sum, monthly payments, or a line of credit, depending on your preference. What makes a reverse mortgage unique is that you do not need to repay the loan as long as you live in the home as your primary residence. The loan only becomes due when you sell the house, move out, or pass away. In the event of your passing, your heirs can either pay off the reverse mortgage and keep the house or sell the house to pay off the loan. It's also worth noting that the amount you can borrow with a reverse mortgage is determined by several factors, including your age, the appraised value of your home, and the current interest rates. The older you are and the more your home is worth, the more you can borrow. Now, while all of this might sound like a dream come true, it's important to remember that a reverse mortgage isn't for everyone. It's a complex financial product with potential implications for your estate and your financial future. Understanding how a reverse mortgage works is important, but who can qualify for it? Well, that's a discussion for our next segment, so stick around as we dive deeper into the world of reverse mortgages. What are the qualifications for a reverse mortgage? This is a question that many are eager to find out. Let's delve into it. To qualify for a reverse mortgage, you need to meet a few specific criteria. First and foremost, you must be at least 62 years old. This age requirement is set to ensure that reverse mortgages are available to those who are typically in retirement and could benefit from this type of financial arrangement. Next, you must own your home outright, or have a very low mortgage balance that can be paid off at closing with proceeds from the reverse mortgage loan. This is a key requirement, as the equity in your home is what's being accessed with a reverse mortgage. Lastly, you must live in the home as your primary residence. This is because a reverse mortgage is designed to help homeowners continue to live in their homes while accessing the equity they've built up. Now that we know who can qualify for a reverse mortgage, let's look at the advantages. What are the advantages of a reverse mortgage, you might ask? Well, let's dive into some of the key benefits. Firstly, a reverse mortgage can serve as a steady stream of income during retirement. This income is tax-free, as it's technically a loan and not earnings. This can be a significant advantage for those who need extra financial support during their golden years. The second advantage is the flexibility of fund usage. The money you receive from a reverse mortgage can be used for any purpose. Some people use it to cover daily living expenses, while others might use it for home improvements, to pay off existing debts, or even to fund dream vacations. It's your money. You get to decide how to use it. Another advantage of a reverse mortgage is that it's a loan that doesn't need to be repaid until the homeowner moves out or sells the house. This means that as long as you live in your home, you won't have to worry about making monthly mortgage payments. This can provide a great deal of financial freedom and peace of mind. Moreover, a reverse mortgage allows you to retain home ownership. You remain the owner of your home and can continue living there as long as you wish, provided you keep up with your property taxes, insurance, and home maintenance. Additionally, reverse mortgages have a non-recourse feature. This means that if the loan balance becomes greater than the value of the home, neither you nor your heirs are responsible for the extra balance. The lender cannot go after your other assets to pay the debt. Lastly, the amount you owe on a reverse mortgage will never exceed the value of your home. Even if the housing market takes a plunge, you and your heirs are protected. In conclusion, a reverse mortgage can provide a financial lifeline during retirement, offering a source of income, flexibility in spending, and the peace of mind of knowing that you won't have to repay the loan as long as you live in your home. While there are advantages to a reverse mortgage, there are also disadvantages to consider. So, remember to weigh your options carefully before making a decision. What are the disadvantages of a reverse mortgage? A question as prudent as it is necessary. Let's delve into the flip side of the coin. Firstly, reverse mortgages can be expensive. They come with a host of costs, including origination fees, mortgage insurance premiums, and closing costs. Plus, interest rates for reverse mortgages are typically higher than traditional mortgages. Over time, these expenses can add up and might even surpass the initial loan amount. So it's essential to weigh the costs carefully against the benefits. Secondly, a reverse mortgage reduces home equity. Remember, a reverse mortgage allows homeowners to convert part of their home equity into cash. The more cash you take out, the less equity remains in your home. That means if you plan to leave your home as an inheritance, there might be less value to pass on. It's a decision that demands careful consideration. Thirdly, a reverse mortgage may affect your eligibility for government benefits. Certain benefits like Medicaid and supplemental security income are need-based. That means they take into account your income and assets. The funds from a reverse mortgage can push you over the allowable limit, potentially jeopardizing these benefits. It's crucial to understand how a reverse mortgage might impact your benefits before making a decision. And lastly, a reverse mortgage is a loan, and like any loan, it must be repaid. If the homeowner moves out, sells the home, or passes away, the loan becomes due. If the homeowner or their heirs cannot repay the loan, the home may need to be sold to settle the debt. A reverse mortgage is not a one-size-fits-all solution. It's a complex financial product that carries potential risks and rewards. It's important to fully understand these disadvantages and discuss them with trusted advisors or family members before making a decision. Given these disadvantages, are there any alternatives to a reverse mortgage? Well, we'll explore that in the next scene. Are there alternatives to a reverse mortgage? Absolutely, there are several options to consider. Selling the home is one. This could provide a lump sum of cash, and you can use it to fund your retirement or other needs. But remember, it might mean leaving a house full of memories. Another alternative is a home equity loan. This lets you borrow against the value of your home, providing funds without having to sell. However, you'll need to make regular repayments, which might not be ideal if your income is limited. Downsizing is another route. Maybe your current home is larger than you need. Selling it and buying a smaller, less expensive one could free up some cash while reducing your living costs. So while a reverse mortgage can be a good fit for some, it's not the only game in town. As we've seen, a reverse mortgage can be a useful tool, but it's not the only option. Let's recap what we've learned about reverse mortgages. These are financial products that allow homeowners, typically of retirement age, to convert part of their home's equity into cash. To qualify, you must be at least 62 years old, live in your home as your primary residence, and meet financial eligibility criteria. We also discussed the advantages of a reverse mortgage, which include providing a source of income during retirement, allowing you to stay in your home, and not requiring monthly mortgage payments. On the flip side, the downsides encompass high upfront costs, the potential for foreclosure if conditions aren't met, and the reduction of your estate's value. We also explored alternatives to reverse mortgages like downsizing, refinancing, or setting up a home equity line of credit. Remember, it's always important to do your own research and consult with a financial advisor before making any big decisions. Thanks for tuning in.